Hi, everyone. Great to be here. I wish I was talking about this topic 1 year before. Probably it would have been an easier conversation, but nonetheless, it's an important discussion. So I've put some slides together, but it's mainly for some background context, but would love to keep it interactive, understand what your concerns are, what your questions are, and we can keep it a bit more engaging. So brief introduction about myself. I've been with March for about a year now. Prior to this, spent a lot of time in the US, was with Google Cloud, GE, Goldman Sachs, so a bunch of large organizations. Then decided I had enough and then wanted to move back. And been with March about a year, primarily focused on investing in technology and SaaS companies. So a little bit of background about March. We are a fund with about $1.6 billion assets under management. It's founded in 2013 by our two co-founders, Jamie Montgomery and Sumant Mandal. They are based in LA. Our team is headquartered in LA. There are two of us in India. Myself, I'm in Bangalore, and another colleague of mine, Rajan, who's based in Bombay. We typically focus on few sectors, so enterprise AI, automation, cybersecurity, and cloud and data infrastructure. We kind of typically help companies, enter in year 2 to 5 in their journey. Look for value appreciation in between years 6 to 10, and then kind of have a team that has sectoral depth and expertise across the areas that I mentioned, and significant relationship networks in the US. And we kind of some of the portfolio companies that we have invested in India: Unifor, Axel Data, BillDesk, Viana Networks, and ShipRocket. So typical entry size in a Series B to D is first check will be around 10 to 25 million. And then in Unifor, for example, we have invested all the way up to $100 million kind of thing, right? So that's a little bit about background. We host an annual conference called Montgomery Summit in March in LA every year, where we invite about 1,500 people who are customers, part of the startup ecosystem, our LPs, and other portfolio companies as well, just to kind of have an interaction and talk more about what's happening in the market and how things are shaping up. Right? So in terms of what I'll cover from a slides point of view is, venture capital in general as an asset class is undergoing a reset. Venture is cyclical, but innovation is still happening. And what does it mean for all of us in terms of people who are building right now? How does it impact valuations? How does it impact funding? How much do you raise? What metrics should you look at? I'll talk a little bit about that as well. Right? So if you look at cloud software public valuations, they have corrected significantly, as we all know, right? So if you look at what pre-COVID mean was, it was around 7x in terms of a next 12-month revenue. And we are roughly at around 6x as of last month kind of thing, right? So typically we have reverted back to mean, even though it might seem like we have corrected a lot. But traditionally, all through up to 2019, we have been in and around this mark, right? So even if you look at VC investment activity, right? So it has gone down significantly over the last 6 quarters. Right? Even exit activity, which is tied a little bit to your investment activity as well, has been down. Opportunities for taking companies public has gone down given the public market correction as well. If you look at the different inflection points where we've had such sort of correction, you had the dot-com bubble where, the correction was about, from 64 all the way down to 38 in 2000, 2001. And similarly, the amount that was raised by US VCs during 2008, 2009 was also a significant correction. And if you look at the current reset, it's right in between the dot-com and the global financial crisis. So there is a significant correction that has happened. Right? So if you look at Series A investments, it's been down 63% from Q1 of 2022 to 2023 Q2. And deal count is also down significantly. Series B is even more significant kind of thing, right? So as you're going up the stages, the correction has been even more prominent kind of thing, right? Series A median deal size has also corrected. So, but I would say it's still better than what it was 5 or 6 years back. It's just that during COVID times, the market had inflated so much that the correction seems a little bit more pronounced here. Similarly, for Series B, the average deal size has dropped about 33% over the last 6 quarters, right? So this was a little bit of level setting, and this is where I want to focus majority of the time, right? So what does this mean? So I think given all of this, there'll be a lot of questions typically when we are engaging with potential investment companies as well, is how companies are starting to think about funding, how they are thinking about capital allocation, revenue growth, so on and so forth, right? So I think the problem that each one of you is trying to solve still holds significance in terms of what it was during the bubble or what it is today kind of thing, right? So the market that you're trying to go after, if it's a large market or it's a small market with fewer players, but you're still looking to kind of disrupt it, that problem statement remains unchanged kind of thing, right? Irrespective of what environment we are in, right? Target market, like I said, right? Like identifying and narrowing down what your target audience is, what the customer is looking to buy, is still remains extremely prominent kind of thing. In fact, there have been instances where we've looked at companies over the last year or so. They have had funding challenges, they've had runway issues, but the problems that they were looking to solve are still massive, or the potential outcomes for both the entrepreneurs as well as the investors are potentially massive. So in that case, even as funds, we are willing to double down irrespective of the challenging environment, because the market and the customer still holds significant prominence kind of thing, right? Product market fit, right? So identifying as you're looking to kind of, raise a Series A or a Series B, in Series A cases, PMF indications, are you clear that these are the number of customers that you have, and is your product being widely adopted without you having to do a lot of heavy lifting kind of thing, right? Are there indications of that? In a Series B case, it's a more metric-driven outcome where it becomes a little bit more clear, number of customers, average ACV, so on and so forth, right? But in a Series A case, it has to be a little bit more on the early indicator side. So the number of customers becomes important, your average ACV, how is your ACV trending over time kind of thing, right? So those are some indications where you can potentially see what an investor will kind of look at kind of thing. ARR and ARR growth. Now, during the bubble, everything was about ARR growth kind of thing, right? Now, I think in general, from investors' point of view also, we are taking a much more, holistic approach in terms of looking at how sustainable the quality of revenue is. What are the factors that are driving ARR growth? Is it cyclical? Is it something that is long-term and sustainable kind of thing, right? Even if it is not extremely high ARR growth, but you're doing it in a much more capital efficient manner without burning too much, that obviously adds a lot of value, compared to what the situation was a year or a year and a half back, I would say, kind of thing, right? So, and the predictability of ARR, I mean, a lot of times we've noticed that as you're moving from seed to Series A, it's hard to have predictability in revenue kind of thing, right? But at least if there are indications that, okay, this is your ICP, these are the number of accounts that you're going after, and over the past quarter or 2 quarters, you have at least been able to demonstrate that what you're projecting to what is coming out is more or less in the ballpark. That gives a lot of confidence to investors as well, right? Like earlier what we are seeing, like people were predicting X and you are reaching half of X, right? So you don't want to be off by that big of a margin. You want to be as close. Ideal is if you're able to beat your plan kind of thing, right? So having some sort of visibility, and this becomes more pronounced as you become more mature into a Series B kind of a round, where you need a much more predictability, both in terms of what your plan is, how much you're achieving, and your pipeline conversion as well kind of thing, right? So I think balancing on ARR growth along with your LTV CAC, along with your burn multiple, and having sales predictability is becoming more and more important, I would say, kind of thing, right? So LTV CAC, I think this is especially important, and I'll break this down into 2 models, right? So one is your inbound model where, you are doing a lot of selling predominantly through AdWords or focusing on an SMB or a mid-market kind of an approach, your LTV could be good, but your initial investment in CAC is high kind of thing, right? So how do you look at trending? How do you look at when the CAC would flip? Or when do you when you go outbound, how will that metric change kind of thing? So having a line of sight and having a viewpoint on how your LTV CAC metrics will change as you're looking to fundraise is becoming more and more important kind of thing, right? Now, in the second bucket, if you're focusing on larger ACV deals, enterprise kind of an accounts, then obviously your LTV CAC is a different approach kind of thing, right? Because your sales cycle is longer. So think of it in terms of like how much are you investing in your sales execs, account execs, and how long is it taking for you to close a particular opportunity, right? So always think along those lines when you're, especially investing in an enterprise kind of sales motion, I would say, right? Burn multiple, I think, I've got some ideal ranges that we typically look at. So in a Series A kind of an opportunity, on the lower end of side, 0.75 is excellent. Obviously, there's a wide range there, 1.25. Now, I would not look at burn in an isolation. Coming back to an earlier point, you always want to collaborate it and confirm it with your other metrics kind of thing, right? So how much are you having to burn in order to generate a $1 million of an ARR kind of thing, right? So, and for a Series B, obviously it becomes much more tighter. You want to see your burn reduce as you're looking to scale up kind of thing, right? So, and net revenue retention is becoming more and more crucial. I think, again, breaking it into two buckets, if you're SMB or mid-market focused, it's okay to be around 100, 110 buckets. But if you're enterprise, you want it north of 125, as much as possible kind of thing. And if it's, especially in the first bucket, I know it's harder because a lot of it is month by month, quarter by quarter. But as long as there's a trend and there is an opportunity to kind of optimize and show a pattern that you are heading towards the right direction, I think there is investors would appreciate that kind of thing, right? So I think these are the broad contours that I had laid out, but happy to take any questions specifically to what you're looking to fundraise. And if there are specific questions that you have around that, either now or even later, happy to engage on that. Any questions? Yeah, please.
Is it possible to go back to, I think you showed some revenue multiples.
Yeah.
I mean, my fundamental void in brain is, so where this comes from? This is
public software.
This is public
markets.
public market SaaS companies, right?
Yes, right.
All or what sort of revenue range SaaS companies? Because public market also you can talk about Salesforce and then or maybe mid market and all those.
So this is calibrated to from anywhere from 10 million all the way up to 200 million.
Okay. So the question is,
and it's a median multiple. It's not mean. So obviously there are outliers which are taken out.
I think that balance will be needed. So the question is that the only benchmark we should be looking at?
It's not.
Because
it's one of them.
It's one of them. Right now, think about it, right? I mean, maybe because public market also a lot of liquidity, a lot of stuff happening on NASDAQ and all those kind of things, right? I mean, everyone was saying, okay, it will be hard, but NASDAQ is growing. Inflation is a separate conversation altogether. Okay, so I got your point. Now the follow-up question is, what do you think next couple of years? What is your thought on multiples? That will help. Sure, thank you.
So I think on the first question, I think this should be used as one of the reference points. It's not the only reference point, because a lot of public market companies will be growing at 30 to 50% as compared to a private market early stage company, which will be growing at a much higher rate kind of thing, right? So obviously there'll be a premium for that kind of thing. But this is a benchmark typically investors would look at, right? Because when you're investing at a growth stage, either maybe late Series A or Series B, as an investor is thinking, is IPO an option? So if IPO is going to happen, how long is it going to take? And predicting what exit multiple he or she can look at that point of time, right? So it's coming more from that angle kind of thing. Now, the way the markets are currently, I think it's more or less in the range of where things were prior to the hype cycle, which we were there here and here kind of thing. So I don't think that is coming anytime soon, especially given where US inflation rates are, credit rates are, all those kinds of things. I think next couple of years, you would see maybe a post, I think next 2 quarters, they'll still be hovering around this, but then maybe a slight uptick and then stabilizing around that kind of thing, right? So once the Fed starts cutting the interest rates, which might happen sometime late this year or early next year, once there are signs of US economy recovering, then you will see a slight uptick and then stabilizing around that kind of thing. So I would say don't expect this. I would say maybe a 20, 30 to a 40% uptick from this, but not more than that kind of thing. Right? So that would be my best estimate, I would say. Yeah, go ahead.
Hi, Ravi. So you mentioned a lot of objective metrics, which are quite standard, but wanted to know your take on the quality of the team, right?
Yeah.
Especially on the sales and the, let's say, tech side.
Great question. So I think on Series A, I would still say it's the most important. Especially what we have noticed is as you're looking to scale in the US, and companies have hired experienced VP of sales, and it's not worked out in a lot of cases, right? I mean, they've made their money, they want to do it because they like it, but the hunger and the drive might not work out. There might be a culture clash. There are so many different reasons kind of thing, right? So typically, from a sales point of view, young director of sales who has a strong ambition to grow is some of the successes that we have looked at kind of thing, right? So I would say early on in their career, but with decent experience, especially in enterprise, if you're targeting the enterprise market. But there's a lot of hunger to kind of grow in their professional lives and also kind of learn new things kind of thing is where the sweet spot is. And typically going the large company route, at least in my experience, hasn't worked out. The ideal case is a hybrid of experience where you can bring in the large company experience and structure and mix it in with, working in a startup and trying to kind of figure out, where my next sale would come from. So that would be an ideal case. But if you're indexing and you have only one to choose from, I would choose the startup route rather than the large company route kind of thing, right? Because structure you can always put in place through sales ops, revenue ops, and so on and so forth. But that willingness and hunger to hustle is something I would index more on from a team point of view. Does that help? Yeah. Yeah, go ahead next. Sorry, I'll come to you next. Yeah.
Hello. Hi, Ravi.
Yeah, hi.
So, Ravi, we are a SaaS-based company at a 3 million ARR right now. Typically working primarily in Middle East market.
Okay.
Saudi and UAE is something that we have cracked on. We are bootstrapped. So, I understand VC, it's a two-way process, right?
Yeah.
It's a light of a marriage.
Correct.
So, what should a company like us, apart from the capital, look in from getting a right VC from a strategy point of view?
Sure. So I think, that's super important because you want somebody, who can act as an advisor, somebody who has experience in the area that you are particularly focused on, somebody that you can trust, right? So things might not work out all the time, right? Like you might miss your numbers one quarter, you might miss your numbers another quarter. But at least you have somebody that you can say, hey, these are the reasons why I think we are not hitting plan, but these are the reasons why we think we can hit going forward kind of thing, right? So that mutual trust between the two is something that you will need to establish. Somebody with experience, like especially the market that you're catering to, somebody who understands that market. So it's Middle East market is completely different from a North American market or an Indian market kind of thing, right? So somebody who appreciates the challenges of selling into the Middle East market, the opportunities that exist there, somebody who can potentially open some doors for you, and somebody that you can trust and rely, like coming back to that, for not just business related decisions, but personal related decisions, culture related decisions, somebody with that kind of experience. And if you're selling into enterprise, I would look for somebody with more gray hair, to be honest, kind of thing, because they've gone through the grind, gone through a lot of different use cases, scenarios in their life kind of thing, right? So I think those are some nuances I would kind of focus on. If it's an SMB, obviously you want somebody who can, who understands that particular space very well kind of thing, right? So expertise, domain expertise, culture appreciation, trust, and what else? And experience is what I would say.
Thank you.
Yeah. Go ahead.
Hello. What are your views on SMB and mid-market in India in terms of adoption of B2B SaaS?
Yeah. So I think it's changed significantly over the last 3 or 4 years. I mean, in general, I think India is a hard market to sell software into. But, I think especially post-pandemic, in SMB and mid-market, there has been good amount of understanding or at least appreciation for this. I think the biggest challenge is price, right? So if you can make your unit economics work in such a way that you can get to scale without burning too much money and get a large enough customer base kind of thing, right? And is your product sticky enough kind of thing, right? Because typically SMB, mid-market, and more so in India, will want to extract the maximum for the least amount of price kind of thing, right? So as a founder, you will find it difficult there's not a lot of wiggle room in terms of new functionality, new features, or if you want to invest in the product kind of thing, right? So if you're able to make that work, then obviously you can, the scale is there, the number of SMBs are continuing to grow kind of thing, right? So unit economics and profitability becomes number one, whereas if you're targeting a North American market, you have much more flexibility kind of thing, right? So that's the...
But another follow-up question. Yeah. How long do you see this scenario, it might take to change this scenario? Because given the fact that the size of Indian market, is it 3 years, 4 years? How do you see the scenario changing as per the current trends?
I think that's a little bit of a harder question, because I would say, given the size of economy and the number of SMB companies that are there in India, you should have already seen that the market is at a much different level than where it's at today kind of thing, right? Because there is still companies that face challenges selling into software, unless you have a different experience, which I would love to hear about. But my personal view is I think it still will take time. It's not something that will happen overnight. I think it's a cultural thing also kind of thing, right? That the ability and willingness to spend on software, whether I can build it something myself by hiring somebody at a much cheaper price point kind of thing, right? So if you're able to show value across multiple facets, not just a single siloed product, then obviously there'll be willingness to kind of pay kind of thing, right? But I still think it'll take some time. Yeah. I know this is probably not the answer you were looking to, but
no, exactly
if you have a different point of view, I'm happy to talk to you separately kind of thing. So. Anything else? Cool. I hope it was helpful, and I'm here for a few more hours, so happy to engage on an offline basis if there are any specific questions as well. Yeah. Thanks a lot.